Welcome to this explainer. Today, we are going to completely shatter a very common, honestly pretty dangerous illusion in the crypto world. We're diving deep into the actual mechanics of how you should be evaluating the size of a cryptocurrency, its potential for growth, and of course, the risks involved. So if you want to stop guessing and start analyzing like a pro, you're in the exact right place.
Okay, let me start by asking you something that trips up almost every beginner out there. When you look at the market, is a crypto coin priced at $1 inherently cheaper or a better deal than a coin priced at $100? Take a second. What does your gut tell you? Because as we're about to see, relying on that instinct could literally be costing you a lot of money.
To get to the bottom of this, here is our roadmap. First, we'll expose the crypto price illusion. Next, we'll unlock market capitalization. Then, we'll break down the 3 market cap tiers, cover how to avoid common investing mistakes, and finally, use all this to build a balanced portfolio. Let's get into it.
Section 1. The Crypto Price Illusion.
You know, it's completely natural for us to look at a coin priced at $1 and think, wow, if this just goes to $10, I've 10x'd my money. It has way more room to grow than a coin that's already 10 grand, right? But that logic is fundamentally flawed in the crypto market. Price is literally just a number on a sticker. It doesn't tell you the actual size of the box you're buying. So if price doesn't tell us the true size, what does?
That brings us to Section 2, Unlocking Market Capitalization.
Market capitalization, or market cap for short, is essentially your ultimate decoder ring for crypto investing. It represents the total value of a cryptocurrency in the current market. And calculating it is a breeze. You just take the current price of a single coin and you multiply it by the circulating supply. And that supply is just the total number of those coins currently floating around out there in the market. And this right here perfectly illustrates why that price illusion is so incredibly dangerous. Let's do a quick comparison. Imagine coin A. It's priced at just $1, but has a massive circulating supply of 1 billion coins. That means its market cap is $1 billion. Now look at coin B. It's got a scary-looking price of $100, but a tiny supply of only 5 million coins. Its market cap is just $500 million. So coin A might look like a steal at $1, but it's actually twice the size and holds double the total market value of the $100 coin B.
No way, right? It all boils down to this really important takeaway. A low-price coin is not always cheap, and a high-price coin is not always expensive. Think about it. If coin A, from our example, is already worth $1 billion, doubling its price to $2 means it has to find another $1 billion of value in the market. That's a huge mountain to climb. Price is an illusion that just blinds you to the actual growth potential. Market cap, that's reality.
Moving right along to Section 3, the 3 market cap tiers.
This gives us a super clear framework. You can basically divide crypto into 3 main weight classes. First, large caps. These are massive projects valued above $10 billion. They offer lower risk and more stability, but the trade-off is steady, slower growth. Then we have mid-caps, sitting comfortably between $1 billion and $10 billion. They offer a balanced, moderate risk-to-reward ratio. And finally, small caps. Anything under $1 billion. These guys offer very high growth potential, but they come with massive volatility and a really high risk of total failure. Basically, risk and reward scale directly with the size of the project.
Now, for anyone just starting out, large caps like Bitcoin and Ethereum should be your foundation. They absolutely dominate the market, have strong fundamentals, and boast high liquidity, meaning it's easy to buy and sell them whenever you want. I know human nature makes us want to chase those massive 100x returns in the small cap tier, but beginners are generally way safer sticking to these established titans. They are far less likely to be completely wiped out by a sudden market crash compared to those unproven smaller coins.
All right, Section 4, Avoiding Common Investing Mistakes.
Let's talk about the top 5 traps beginners fall into. We've obviously talked about focusing only on price and ignoring that circulating supply limit. But 2 of the absolute most dangerous are chasing small cap coins blindly without doing any research and totally misunderstanding risk versus stability. People jump into these tiny small caps expecting quick, effortless profits without realizing the intense roller coaster volatility involved. Remember, high reward always demands high risk.
And that brings us to a huge misconception, believing that just because a coin has a low market cap, it's guaranteed to grow. It absolutely isn't. Market cap just shows you the current value. It is not a crystal ball. A low market cap doesn't just magically inflate on its own. For a project to actually grow, it needs genuine utility, real-world adoption, and a rock-solid development team behind it. You've always got to check the fundamentals.
Finally, Section 5, Building a Balanced Portfolio.
One of the absolute best ways to put market cap to work is for portfolio diversification.
A fantastic, beginner-friendly setup looks kind of like this. Allocate 50% of your funds to those stable large caps. Then, put 30% into mid caps for that moderate growth potential. And finally, reserve a calculated 20% slice for the high-risk, high-reward small caps. Setting it up this way drastically reduces your overall risk of a total wipeout, but you still get to capture significant upside as the market expands.
So, to put all of this into practice, just follow these 3 steps. Step 1. Be totally honest about your experience level and figure out your personal risk tolerance. Step 2. Promise yourself you'll never just look at a price tag again. Always screen your potential investments using market capitalization. And Step 3. Use those 3 cap tiers to build a diversified portfolio that cushions you against volatility. If you actively do this, you shift from basically gambling on cheap coins to actually investing strategically.
As we wrap up this explainer, I want to leave you with a bit of a challenge. Open up your investing app today and actually run the math. Look at the supply. Look at the tiers. Ask yourself, are you currently falling for the price illusion just because something looks cheap on the surface, or are you genuinely investing in strong, sustainable market caps that match your strategy? Use this framework wisely, stay curious, and keep exploring.